Hello and welcome to the Business Standard Morning Show. I'm Binu Sandhu. Let's take a look at the stories for the day. Will you be comfortable paying for your daily UPI transactions? This is one of the questions that the Reserve Bank of India has asked of the public as it wants to make this digital ecosystem sustainable. Watch this report to know more.
The Reserve Bank of India on Wednesday sought views from the public on fees and charges in digital payment systems. It stressed that such charges should be reasonable and competitively determined for the users to ensure wider acceptance of digital payment modes. The payment systems include IMPS, NEFT, UPI, and debit cards, among others. In just 6 years of launch, payments made using UPI have become commonplace, with the platform boasting over 26 crore unique users and 5 crore merchants. According to a report by payments company Worldline, UPI person-to-merchant transactions have become the most popular payment method among consumers, holding a market share of 64% in terms of volume and 50% in terms of value in the first quarter of 2022. One of the key reasons for UPI's popularity is the zero merchant discount rate. It is a fee levied on merchants for processing payments. The government has mandated a zero charge framework for UPI transactions with effect from January 1, 2020. As such, charges in UPI are nil for users and merchants alike. But the RBI explained that different stakeholders collectively incur a cost of 2 rupees to process a UPI person-to-merchant transaction with an average value of 800 rupees. The RBI acknowledged that in any payment system, the payment service providers or PSPs should earn income for continued operations of the system to facilitate investments in new technologies, systems, and processes. The various participants in the UPI include the remitter and the beneficiary banks, payer and the receiver's UPI app providers, their PSP banks, and the National Payments Corporation of India. The system facilitates the settlement of transactions using a combination of these participants. While reiterating that the RBI has neither taken any view nor has any specific opinion on the issues raised in the discussion paper, it posed several questions for feedback. Can a tiered charge structure be imposed for UPI based on different amount bands? In the context of zero charges, is subsidizing costs a more effective alternative? If UPI transactions are charged, then should the merchant discount rate be imposed based on the transaction value, or should a fixed amount be charged irrespective of the transaction value? Further, it has sought feedback on whether the RBI should decide on the charges or the market be allowed to determine if any such charges are introduced.
This shift from zero to it could be whatever 0.25, 0.35, 0.5%, whatever it is. I think that can happen in a very gradual manner. Having said that, I think today, as far as P2M transactions are concerned, the merchant is the one who bears most of the costs. And I think that they will be also okay with bearing some cost for the UPI as well, because they are currently paying for debit card, credit card, net banking, all other payment modes. I think UPI will be just an addition. My personal view again is that the pricing should be ideally attached to the value of the transaction. Just hypothetically, if the charge is say 5 rupees per transaction, but if a particular individual is making a UPI payment of say 20 rupees, for the merchant, it actually becomes a 25% cost. Today, we have for debit card, especially, we've got these different pricing for different slabs. Maybe that is something that can also be considered. For large value transactions, yes, even if it is a fixed price, for example, I think even that is something that should be fine. But I think for P2P, so even if they are kept at the minimal, if not zero, I think even that should be fine.
If you have a small merchant, I think he deserves to continue having zero MDR. But if you have a larger merchant, that person perhaps can afford a certain amount of MDR, right? So one structure which may or may not be right in my mind is, instead of trying to categorize who is a small merchant or a large merchant, just see the value and volume of transactions that are happening against the merchant. A percentage actually is a good number. If it's a large value transaction, then the MDR is a little higher. For a very small value transaction, the MDR, because the percentage can be, and the way you keep the percentage can also, for a credit card transaction, for example, it's in the 1.5% range. For a UPI transaction, doesn't have to be that high. It can be a lot lower. A flat fee actually becomes prohibitive for really, really low value transactions. So I think it should be still okay, right, to keep P2P as zero.
The industry says the days of free UPI transactions cannot continue forever, but at the same time, it is not in favor of the government subsidizing it through budget every year. Experts say P2P payments should be kept free, while the charges can be recovered from the merchants for P2M transactions. Though there is a difference of opinion on what could be the ideal pricing structure, protecting smaller merchants and encouraging small ticket transactions remains the priority. Industry executives believe pricing should be market determined through competition, with the RBI only stepping in if monopolistic tendencies are seen. Despite its meteoric rise, UPI still has a long way to go in terms of adoption. Therefore, settling on any pricing mechanism will be a balancing act between growth of digital payments and incentivizing the system.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं? ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं? वो तो सबसे आसान है। तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
From the central bank, let us shift our focus to the corridors of the Supreme Court. The country's top court has asked the government to intervene to ensure that India gets to host the Under-17 Women's World Cup in October. FIFA has suspended India over undue influence from third parties. Here's a report with more on the ban and its likely implications.
For the girls of Sri Gokulam Kerala FC, India's top women football club, the 16th of August flight between Kozhikode and Tashkent was not just between two cities, it was between two different emotions, hope and despair. Soon after landing in Uzbekistan to play in the AFC Women's Club Championship, the Asia's apex women's club competition, they were told about the news. FIFA has banned the All India Football Federation for excessive interference by a third party. This action meant that the Under-17 FIFA Women's World Cup, all set to be hosted by India in October, stands suspended. The move will also have larger adverse implications for the game in the country. It meant that the national football teams cannot take part in FIFA tournaments, which include the qualification matches for Asia Cup and for World Cup. So why did FIFA take this extreme step? The AIFF's constitution and elections were at the center of a dispute between FIFA and the Supreme Court appointed Committee of Administrators. The COA had prepared a draft constitution that was opposed by the state assembly bodies in the first place. It also decided to form an executive committee which would involve a 50-50 representation of players with voting rights and state assembly members. FIFA saw it as a violation of the rules and a deviation from what was agreed upon earlier. FIFA wants the AIFF administration to be put back in charge of day-to-day operations, a revision of constitution and an independent electoral committee overseeing the elections. The Supreme Court told the government to take proactive steps with FIFA and set things right. The Under-17 Women's World Cup is scheduled to kick off in mid-October, and the ticket sales for the event has started earlier this month. Experts say even though it is difficult to put an exact number on the loss the AIFF might incur due to advertising, media and other deals, it will likely be minimal if the tournament eventually moves out of India. According to FIFA, the investment in the Under-17 FIFA World Cup tournament is budgeted at $21 million. If we look at the Under-17 Men's World Cup that India hosted, the global brand and India sponsors shelled out relatively small amounts on television advertising, while broadcaster Sony spent about 50 to 60 crore rupees. According to a FICCI report, the tournament recorded the highest attendance for a FIFA Youth World Cup in history and garnered the highest viewership among international football tournaments broadcasted in India. Currently, there are only global brands and no national brands associated with the Women's World Cup, but they might step in closer to the tournament. Viacom 18 is the broadcast partner for the upcoming Under-17 Women's World Cup. But more than the Women's World Cup, experts say there will be bigger financial implications for the overall football ecosystem in India due to the ban.
It's not just the media rights, it's not just the sponsorship rights that go away along with the entire game that's not being allowed to play. But more importantly, there are equally high stakes in people who are investing behind it because they have teams, they have created advertisements, already must have been created. It takes about 3 months to create. So all that investment is already gone in. And it is a completely come to a naught, which means zero. So that money is completely lost. See what's happening. It's a climbing ecosystem. We have just about entered the sport. We are a fledgling country. In the under-17, we don't even feature in the top 15, 20. We don't feature there. I mean, in the list. So we are not we are just a climber. We might say we might be greenhorns in this particular sport. There is a chance that it will impact sport as a whole, but as the football sport. But more importantly, if they take quick action, solve the issue, resolve the issue, then it will not have a long-term impact. But if we don't play the football for a year, then there is going to be a challenge. If you don't play any international matches for a year, if no other international teams come here, then there will be a challenge. Then the whole sport and therefore the money behind the sport. And naturally, I will get scared as a sponsor, right? I mean, I will get scared as to what is the next step that All India Football Federation Association will take. I will not be very comfortable because I need to be comfortable with investing money behind such a sport.
If the ban continues, AIFF will also be stripped of FIFA's funding, which could lead to a stress on the finances of the federation. According to a Business Standard report, 40 to 50% of football sponsorship money could be impacted due to the ban. Advertisers could also pull back some of their investments in football leagues such as the Indian Super League. After the successful hosting of the Chess Olympiad, the Under-17 Women's Football World Cup would have given another leg up to the non-cricketing sports in India, not only in terms of eyeballs but also private capital. It is unfortunate that the tournament is stuck in administrative slack.
क्या हाल?
मत पूछ यार,
फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
A good showing in the Under-17 Women's World Cup could help revive the fortunes of the game in the country. Meanwhile, the onset of the festival season is adding sparkle to the jewellery sector, with gold prices correcting over 12% from their March peak and is forecast more upside in related stocks. Here's how.
Jewellery players like Titan and Kalyan Jewellers posted better than expected earnings performance in the June quarter. While jewellery retailer Kalyan posted consolidated profit after tax of 108 crore rupees in Q1 of FY23, Titan saw 13-fold jump in net profit year on year to 763 crore rupees. Going forward, Kalyan expects store expansion, increased studded sales, and higher share of non-South business to aid margin profile. Titan, meanwhile, expects margin of jewellery business to grow 12 to 13% in FY 23-24 on the back of better revenue mix and network expansion. And with the usher-in of festive season and softened gold prices, analysts expect the demand momentum to gain steam.
No, I think the re-rating should happen because gold prices are stable, okay, and they are expanding, and there is a shift from unorganized to organized sector, which is benefiting organized jewellery makers. So Kalyan Jewellers, valuation-wise also it is attractive. Titan is our top pick.
That said, the World Gold Council has raised red flags against gold demand. According to its latest report, the demand for gold may drop in the second half of calendar year 2022 due to uncertain macros and higher import duty on gold. Analysts warn of painful quarters down the line once festive and wedding season peaks off.
See, there are two things. One is this jewellery there's a lot of pent-up demand and marriage season demand. So one good quarter, we should not get too excited. And secondly, there's also consolidation happening from the unorganized jewelers to the organized jewelers. So that is benefiting them. So broadly, on a longer-term basis, one can be bullish on the jewellery stocks. But just because one quarter has been good, you don't get too excited about them. You keep accumulating one or two of them as and when you think that the timing is right. Because the stock price have already moved up, and entering at these prices may not be advisable in that sense. Typically, July to September, the marriage season is very limited. Only some festivals come in, and then the next quarter will be again good. So September quarter may not be as good as the June quarter. So that one will have to keep in mind.
On the bourses, shares of Titan have shed over 1% so far this year, whereas Kalyan added 3%. In comparison, the S&P, BSE Sensex and Nifty 50 gained 3% each during the same period. As regards today, rupee movement, FII flows, crude oil prices will continue to steer market movements. Globally, investors will monitor UK's retail sales data for July.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है Investing made easy and reporting with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
After markets, let us head into the world of space and satellites. Earlier this month, a small glitch derailed an ISRO plan to place lightweight satellite into orbit. For the newly built Small Satellite Launch Vehicle, or SSLV, which was carrying these satellites, this was the first assignment. In the days ahead, there's a lot more that is in store for this satellite launch vehicle. Let's find out more about this.
The government recently told the parliament that it was eyeing a share in the global satellite launch market. Minister of State in PMO Jitendra Singh said that state-run New Space India Limited is envisaging launches of several foreign satellites on board ISRO's SSLV, PSLV and GSLV MK3. A market for launching small satellites into low Earth orbits has emerged in recent years. It is driven by the needs of developing countries, universities, and private corporations. The SSLV aims to cater to this market. After the Polar Satellite Launch Vehicle and Geosynchronous Satellite Launch Vehicle, the SSLV is ISRO's third launch vehicle. Weighing in at only 110 tons, the SSLV is ISRO's smallest launch vehicle. It also takes only 72 hours to integrate, unlike the 70-day period for other launch vehicles. It can carry satellites weighing up to 500 kg to low Earth orbit and provides an alternative to ISRO's current workhorse, the PSLV. The latter can carry satellites weighing in the range of 1000 kg. The SSLV is also capable of multiple orbital drop-offs, which allows it to launch multiple microsatellites in one launch. Add to that the key features of low cost and turnaround time, launch on demand ability, minimal launch infrastructure requirements, and the ability to accommodate multiple satellites. Referring to SSLV, former ISRO chairman K. Sivan had in 2019 said that only 6 people will be required to do the job instead of 60 people. The entire job will be done in a very short time and the cost will be only around 30 crore rupees. It will be an on-demand vehicle.
I will achieve, I will fly high, ISBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Meanwhile, Space Commission member A.S. Kiran Kumar has reportedly said that SSLV D1 will not be a setback and that the space agency will attempt another flight. That's all for today. For more news and analysis, please log into our website www.business-standard.com. And we'll also be back tomorrow morning with more. Stay tuned and thank you for watching.
If you liked this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.